Hello guys, hi, welcome back. Welcome to your third and the last demo session for taxes as well as ATX. So all the tax and ATX students, come on, keep your eyes, ears open, and we are discussing the second part of chapter 2, which is about the income tax computations. And we're just going to begin in a minute. So all of you get your calculators in place and we are beginning. Okay, so I hope that everybody has got their respective calculators in place, and I'm sure I'm audible and visible to everybody. And I think we are able, my audio and my video is absolutely clear. You guys have calculator with you that I need you to carry for doing today's session, because we will be doing questions, we'll be doing calculations, and I need you to be carrying it. In case if you find any audible issues and any video issues, then please type it in the chat box and I'll get it corrected. Okay, then I think let's begin. So before I begin, let me give you a quick recap of what we covered in the yesterday's session. In the yesterday's session, we looked at the performer and that we were discussing as an example, right? So in the performer, then I think we covered about how do we classify the income, how do we segregate the income? We segregate the income under non-savings, savings, and dividend categories. Okay, then we place the interest related income in the savings income, the dividend that we receive, and the dividend that is earned on the shares is placed under the dividend income, and the other income like income from employment, okay, income from property, business income, income from your trading income, that is your trading profits less the losses. I told you that we will discuss losses only when we go to the losses chapter. So we take all these income, we put them together and we write it here as total income. Then from total income we reduce two reliefs, which is qualifying interest relief and the loss relief. I will be covering qualifying interest relief today in the class, and then we get here net income. Finally, from net income, we reduce the PA, which is personal allowance, and we get here then taxable income. This taxable income is then finally put to taxes, where we tax it as per the special rules. So for NSI, there is no special rule, and let's just revise the rate band. The rate band that we follow is, this is the textbook. You will get everything in this book as well. Okay, so the rate band that we follow is, for the basic rate band, the tax rate is 20% and it is still 37,700 of your income, of your total taxable income. Then when the total taxable income goes beyond 37,701 till 125,140, we will tax it at 40% and we call it as higher rate band. Okay, for NSI, SI, the rates will come in the same way, the same rates. And for additional rate band, that is when the total taxable income goes beyond 125,140, we tax it at 45%. Now, the nil rate band for, okay, I'll come to nil rate band, but now we just note the taxability. So we always tax it as category wise, NSI, then SI, then DI. That is non-savings income, then savings income, and then dividend income. When I come to non-savings income, then it is to be taxed normally at these rates and there are no problems. I mean, no differences here. When we come to savings income, then guys, I want your attention, because then we have two nil rate bands applicable. First is the 5,000 starting nil rate band that says that till the level that your NSI is not crossing 5,000, for that difference between the level of NSI income and 5,000, you will get a nil rate band for to be adjusted against the savings income. That means, for example, if NSI is 2,000 and then your savings starting 5,000 nil rate band, you will get is 3,000. Because with 2,000 NSI, when I get 3,000 more, then it becomes 5,000. So 3,000 difference will be a nil rate band for savings income. That means at this 3,000, tax rate will be 0%. Then another nil rate band of savings income is depending upon the category of the taxpayer. So we get the total of the total taxable income. That is, we get the total of the taxable income of the taxpayer. If that taxable income, the total, if it is within the basic rate category, then we say the taxpayer is a basic rate taxpayer. If that extends up to the higher rate category, that means the maximum rate applicable to the taxpayer is the higher rate band, then we say that the tax rate applicable is 40%. However, if I say that this get extended to even more higher category, that is the additional rate band, then the category of the taxpayer is 45, is the additional rate taxpayer. Why I need this category? Because when we establish that the savings nil rate band, that is the second nil rate band, I need to see this category. So for a basic rate taxpayer, he will get 1,000 in addition to your starting 5,000 nil rate band. He will get this 1,000 as the nil rate band, savings nil rate band. That means in addition to the 5,000 starting nil rate band, this 1,000 will also be taxed at 0%, like we did it yesterday in the examples. Then for a higher rate taxpayer, this amount is 500, and for additional rate taxpayer, there is no savings nil rate band applicable. Clear? Now, when we move to dividend income, then for dividend income, there is by default a nil rate band of 500 that is applicable to the all taxpayers, all category of taxpayers. And beyond that, the income that will be taxed will be depending upon it is in which rate band. So, and the tax rates for dividend income is different from the tax rates for the normal rate band. So, it is 8.75% for the basic rate band. For higher rate band, it is 33.75%, and for additional rate band, the rate is 39.35%. Now, you don't need to memorize these rates. This will be given to you in the exam to follow and to check. Okay, anyways, now we are done with non-savings income, savings income, and dividend income, the rate bands. Then the next step that we understood was the P. The the personal allowance is 12,570, but if the PA, there can be a situation where your PA is tapered. That means you will be reducing your PA. So when do we do that? That is when the adjusted net income exceeds 1 lakh. Now what is ANI, adjusted net income? It is simply net income less two things. First, gross gifted donation. Second, gross personal pension contributions. So if that exceeds 1 lakh, then we follow 4 steps. Number 1, calculate ANI. Number 2, calculate the excess over 1 lakh. Number 3, get 50% of excess. And fourth is the tapered P. That is, this by the amount of 50% of excess, you will reduce your PA. So what you get is a tapered P or reduced PA. Finally, that reduced PA will be reduced from the net income. Now, when we reduce PA, it is always done in the sequence that first PA is reduced from the non-savings income, then the PA is reduced from your savings income, and then it is reduced from dividend income. All this we covered yesterday in the class. Okay, all these portions. I'm just recapping what we have covered in the yesterday's session. Then one more point we covered, and that was a transferable PA. That simply means if both the spouses or the civil partners, they are in the basic rate category and they are in the basic rate band only, that is their income is within the basic rate band, then if one of the spouse, let's say, is desired of transferring the PA to another spouse, then they can transfer, and the transferor spouse can only transfer 1260 of PA. So that will reduce their personal allowance by 1260, and the spouse who's receiving it, the transferee spouse, will get the benefit in the form of the tax reducer. That is, their tax liability will be reduced by 252, 1260 multiplied by 20%. It's a fixed amount. Right, so all these portions with examples and questions we had covered in yesterday's class. In today's class, now let's go further and let's see more. Yes, Krunal, you can. Of course you can. Yes, but then you will be able to appear for the exam only after your 12th. Okay, but yes, you can start preparing for sure. Okay, now let's continue further for this topic. Yeah, so yesterday's session we covered about the income tax. So we covered what is income tax, taxable income, what is the tax year. Okay, now I am also going to cover some topics that we did not cover in yesterday's session that I'm going to cover today. And also ATX students, once we cover these basics, I'm going to cover some portions and the performer for you as well, that is applicable for you, for your exam purposes. So I'll cover that portion as well. Most welcome, Krunal. And right now, Krunal, I'm discussing the tax paper, the UK tax paper, okay, United Kingdom tax paper for your ACCA exams. Okay, now let's go further. So we have discussed these terms. Now, one thing that I want to discuss is exempt income. Comes the point, ma'am, what is exempt income? Exempt income means that income that will not come into computation of tax only. That will be out of the computation of tax. Why? Because it is exempted by HMRC. HMRC says that on this you will not required to be paying any taxes. You will not pay any taxes on it. Okay, so it is your exempt income. It will not come in your computation of tax. Which is that exempt income? Number one, income from national savings certificates, statutory redundancy payments. Let's understand them one by one. National savings certificates are like in India also we issue. It's like a document that's a national savings certificate issued by the government, the national agency, and any interest that you earn on that certificate is exempt. That means even though you are earning interest, but that will not be put to tax. Okay, it will not be taxed anywhere. So interest will be exempt. Statutory redundancy payment. Let's understand them in breaks. Statutory means which is given as per the government limits. Okay, as per the government, you can say regulations, this amount is paid by employer to employee. And why do you think employer pays this amount to employee? Because he has fired the employee. You must have heard, no? Google has fired, Meta has fired, TCS fired. So a lot of companies have fired the employee. They suddenly give them a mail and they say, boss, you're no longer required to come to the work. So when there is instant firing, so then the employee should get time and should get money to search for a new job. So as per the government regulations, then this statutory redundancy amount is paid to the employees. And statutory means this is the minimum amount that has to be paid to the employees because now they have become redundant. Redundant means they have been fired. So because they have been fired from the job, now they are jobless. So you need to pay them a basic amount, an amount which is fixed by the government. Of course, employers will pay more than this, but this is the minimum amount that needs to be paid. So any employee who is receiving the statutory redundancy payment will not be required to pay taxes on it. It will be exempt because of course it is given to meet their hardship. Clear? Now let's go to the next one. Winning including premium bond prizes. Winnings is basically like winning from race horses or all. That is exempt in UK. So that is contrary to Indian taxes. It is exempt in UK. I'm coming to it. Somebody has asked me question, ma'am, what is individual savings account? I'm coming to that point, okay? So just keep listening to me. I'm coming to that point. I'll take one by one all these. Yes. Okay, now coming to the next one, premium bond prices. Ma'am, what are premium bond prices? Premium bond prices, basically I'll tell you what happens in UK. In UK, the government issues some bonds, which generally in the denomination of 50, 100 or more than this, and any citizen of the government, the UK government, is UK, can apply for those bonds. So they are basically they give you tax free income, and when you sell them also you earn any gain that is not taxed. So any and then government keeps a lucky draw every week, and in that lucky draw, if your bond is coming, then you will get some multifold amount, lot of money you will get then against it. So if you're winning like that, no, against the bond, that is known as winning of bond prices, premium bond prices. So if you're winning these premium bond prices, then it is not going to be taxed. Very good. So if you have applied for those bonds in UK and then you're earning these prices, it is not going to be taxed, it is exempt. Next, scholarships. So any kind of scholarships in India also it is exempt. So any kind of scholarships, whether you are as a student, as an employee, as any person who's receiving scholarship from anywhere, it is exempt, it is not taxed. Next, interest on the compensation for personal injuries. You are met with an accident. You hear on the news, right? Somebody is met with an accident and the government is giving them some amount, 20,000, 50,000, 1 lakh. So if you're receiving any amount because there was a personal injury, maybe given by the employer, that is not taxable. Local authority grants, like any grants given by your local municipality to support your education, to support the health or any other point, it is not going to be taxable. Income arising from investments within individual savings account. Boss, we call it them as ISA in short. What is individual savings account? See, in India also we have savings account. No, in the bank we open the savings account. In UK also we have savings account. But then what is individual savings account? These are special savings account which are in the banks, in the post offices, which is allowed by government, and they are called as individual savings account. Now what is so special about it? That as an individual, whether it's me, you or anybody else, as an individual, I can deposit up to 20,000 pounds in this account in a year. Maximum limit is 20,000 pounds you can deposit in this account in a year. What is the use? The use is that any interest that you earn on this account, because we earn savings interest, right? So any savings interest that you earn from ISA accounts, we call them ISA, is exempt. No tax on it. So up to 20,000 you can invest in a year. Yes, year on year you can have accumulated amount. But maximum amount that you can invest in a year is 20,000 pounds only. And that any interest that you earn on it is exempt. It is not taxable. Number one. Number two. So this ISA where you are investing money, is known as cash ISA. Cash ISA means you're investing money just like a normal savings bank account. Second is like a demat account where I am not investing money in the account like a savings bank account. Okay, but I am investing money like a demat account. That means now this ISA is not cash ISA, it is known as stocks and shares ISA. So now here I'm investing into the shares. This is like a shares account and I'm investing into the shares. Again, what is the benefit? See, when you invest into shares, what do you earn? Dividends, right? So any dividend that we earn from this is exempt. If you sell the shares, that you will study later on. So when we sell shares, we have a capital gain tax. Okay, when you sell shares, you earn gain. That gain is known as capital gain. And the tax that is payable on it is capital gain tax. But if that is a stock in share ISA, in which you invested and now you want to sell share from there, then that gain, then tax is also exempt. So here you will not pay any taxes on savings income. You will not pay any taxes on dividend income that you're receiving. You will not pay any taxes on the capital gain that you are earning on the sale of the shares from stocks and share ISA. So it is a complete exempt account, and so it is very beneficial. Now, you can ask me, ma'am, what if we invest more than 20,000, the account will not allow you only. Because the maximum capping is 20,000 you can invest in a year. You cannot go beyond it. Clear? So this is known as individual savings account that we say as ISA. We have two types of ISA. One is the cash ISA and other is the stocks and share ISA. I hope I'm absolutely crystal clear on it. Then yesterday we also discussed about personal allowance, and people don't forget about this exempt income, because one thing I want to highlight here, and please remember it's very important from exam point of view. Income from national savings certificate is exempt, but sometimes your question will confuse you and will say there is income from national savings account. Is this also exempt? No, it is not exempt. It is taxable. So it is completely taxable. Remember that income from national savings account is exempt, but income from national savings certificate is exempt, but income from national saving account is completely and fully taxable. I hope I'm absolutely clear on it. Let's go further. So in yesterday's session, we discussed about PA and the restriction. Now I'm taking one topic that I've always found students to be facing trouble whenever they are solving questions. And therefore I've included this topic. And this is a topic on reduction of PA and marginal tax rate. Very important, and I want you to understand with an example. So let's take an example to understand this. Okay, let's take an example. The example is that I'll take it here. Now, yesterday we discussed about where the PA gets reduced. Now, I'll take an example. Let's take that my ANI is 1,10,000. Then, how do we calculate the tapering? Let's repeat the steps. Step 1, calculate excess over. Actually, step 1 is ANI. This is step 2. Calculate excess over 1 lakh. Excess over 1 lakh is 10,000. Step 3, calculate 50% of the excess. 50% of the excess is 5,000. So now your tapered PA will be, that is your reduced PA will be 12,570 less 5,000, which is 7,570. Clear? But now here comes the problem. Now look at the situation. When your adjusted net income is 1,10,000, let me assume it is your net income also. Okay. Normally, this extra 10,000 is coming in the higher rate band if I talk about taxes, because it is much exceeding your 37,700. So it is coming in your higher rate band. If I talk from tax point of view, I can say that this is taxed at the rate 40%. Why? Because it is coming in the higher rate band. So it is to be taxed at 40%. Clear? If I would have got full PA, then I would have got benefit at the rate 40%. Right? If my full PA was there, I would have got the benefit at 40%, because then my higher rate band would have reduced. Why? See, 1,10,000 less 12,570, then my taxable income was only 1,10,000 less 12,570, 97,430. But right now, what is my taxable income? 1,10,000 less 7,570, and which is going to be 102430. Can you see that your income got increased, and due to which what income in the tax rate has increased? 37,700 basic rate band is remaining same because here also it was exceeded, here also it is exceeded. The difference is that here less income was there in 40%, here more income is there in 40%. How much more? 5,000. 5,000 is the difference, correct? So I can say that on this 5,000 also I am paying tax at the rate 40% only. Correct? Clear? Now, this is 50% of 10,000, right? So if I take this 10,000 as $1, because I want to explain you what is the marginal tax rate that the taxpayer has to pay because the PA got tapered. So when your PA gets reduced, what is the marginal tax rate that you are paying? I'm just proving that. Okay, so look here. When we pay tax at 10,000, let's assume this value to be pound 1. So I can say that pound 1, we are paying tax at 40%. 55,000 is simply 50% of this, right? 50% of pound 1 is 0.5. So I am paying tax on 0.5 also at the rate 40%. Correct. Instead of taking 10,000, I am taking pound 1. So if this is pound 1, then this is 50% of excess. So I'll have to take 50% of this, which is 0.5. Clear? So now do the calculations. 0.1 into 40% is 40%. Pound 5 into 40% is 20%. Total is 60%. So this shows that when your PA gets tapered, effectively the marginal tax that you are paying on this amount, on what amount? On this 10,000. So the total tax that you are paying on 10,000 is actually not 10,000 into 40%. But due to the increase of this 10,000 beyond 1 lakh, if your ANI was still 1 lakh, there was no problem. You would have got full PA. Your problem is only there because ANI has exceeded 1 lakh. So just because there is an excess of 10,000, you are not paying only 4,000 extra as the tax on this 10,000. You are actually paying tax at the rate 60%, which is 6,000. So on this additional 10,000, you are ending up paying 6,000 tax. How? Let's prove it. Let's prove it, guys. Can you see here? I just showed you here. You all agree. 10,000 into 40% is 4,000. 5,000 into 40% is 2,000. Total 6,000. So hence we can prove that the marginal tax rate when your PA gets tapered is effectively 60%. I hope I'm very clear on it. But that amount will always change once you have the tapering. Now let me take one example where let's say the 50% of excess is, you know, no, I'm sorry. It will always remain 60% only because the amount relationship will always be same. So it will be 60% only. Right? I hope very clear with this when I say your marginal tax rate, because I've seen students to be really getting troubled with this marginal tax rate, and they come to me and ask me that, ma'am, I'm unable to understand this. So I hope now this concept is absolutely clear and there is no problem here. I've given you the example also to make you better understand this. Okay, now let's go further. So we have discussed all these portions, we have discussed question also, and now I will take the portion of qualifying interest that I was telling you, that I will be taking the qualifying interest relief. So I'm taking the portion here now. Okay, and I want everybody to be having attention on my screen. So comes the point, ma'am, what is qualifying interest relief? Now let's break this. It is a relief given. Relief means it's like it's going to reduce your tax liability. So it is a relief given. Okay. It is a relief given on what? On the interest amount. Let's go reverse reading. Okay. It's a relief given on the interest amount. Interest amount of what? Of a qualifying loan. So what is a qualifying loan? On which you are paying interest, and the interest that you are paying will give you income tax relief. Okay, so you don't get relief on the loan, you get relief on the interest amount that you are paying. Clear? Now comes the point, ma'am, what is a qualifying loan? Qualifying loan is a loan which has been taken for these four prime purposes. Okay, there are one or two more examples also, but I will take these four prime purposes. First purpose is the loan which is taken to purchase plant and machinery, either by an employee to be used in the employment, that is in his office for office purposes, or by a partner to be used in the partnership. So again I repeat, loan which is taken to invest in the a loan which is taken to buy plant and machinery for either employment purposes or to be used in partnership. Now, what is employment purpose? Employment purpose means, okay, that the employee has bought it, okay, and he's going to use it for his office purposes. So now, what is this plant and machinery? Can we take an example? Yes. For example, I can take laptop. An employee is buying his own laptop to be used in the entity's business, but of course he will only get the benefit for the business use, not for the personal use. If he is watching movie on it, he will not get the benefit for the same. Clear? I hope I'm very clear about it. Okay, now let's proceed more. And likewise for a partner when he is using it for his partnership business. Number two, the loan that he is taken to invest in a partnership. Who will take a loan to invest in a partnership? Partner. So well, let's say the partner has taken a loan where he wants to bring in capital to the partnership. He wants to introduce capital, right? So that amount that he has taken a loan to invest in the partnership is allowed and is basically termed as your qualifying loan. So this is a qualifying purpose and it is allowed as a qualifying purpose. Okay. I'm sorry, I was on mute. Yes. So I hope we are very clear with this, and we have got this understanding of first 2 points. That is essentially what is a qualifying loan. Qualifying loan is a loan which is taken by the employee for use, to buy plant and machinery for use in his employment, or by a partner to, buy plant and machinery to be used in his partnership business. Then second, when a loan is taken by a partner to be investing in his partnership business, like when basically the purpose is to invest into the partnership as a capital introduction. So then we call it as a qualifying loan. Loans to acquire shares in an employee controlled company. What is acquiring the shares in an employee controlled company? What is an employee controlled company? Let me explain you. Employee controlled company is a trading company where the employee himself or the group of employees together, they own more than 50% of the share capital, because then only the control will be there, correct? So when they own more than 50% of the share capital, either employee alone or with the other employees, then we say it's an employee controlled company. Now the loan has been taken by the employee to invest into this company, so then also it is a qualifying loan, because now he wants to acquire shares, probably to acquire the control of this company, right? In order to acquire the control of this company, he is he's taken a loan to acquire shares. Loan to invest in a cooperative, so like any cooperatives that we have in India also, so any cooperative societies which are there, and if there's a loan taken to invest in a cooperative to become a member of that, then that is a qualifying loan. So this is your number 3 and this is your number 4, and only this is the list that is applicable for you under your your taxes as well as the ATX syllabus, wherein we approve this as the qualifying purpose for which the loans which is taken will be a qualifying loan. I repeat again: number 1, loan taken by a partner to invest in a partnership; number 2, loan taken by the employee to buy plant and machinery to be used in his employment; number 3, loan taken by the partner to buy plant and machinery in his employment, in his partnership business; number 4, loan taken by the employee to be, you know, to invest, to acquire shares, that is to invest into shares of an employee controlled company; then lastly, loan taken to invest in a cooperative. Only these are qualifying purposes. So once these purposes are approved, then we say it's a qualifying loan. Any interest amount that you pay on it will be allowed as a relief. So that will be reduced from the total income. Remember, you will never reduce the principal amount. You will always reduce the interest amount from the total income. Clear? Absolutely crystal clear till this point. We will have questions. Don't worry when I'll take these portions. Okay, yes, so we are done with qualifying interest relief as well, and now we move further. Okay, one point that I want to cover for partners, or for the husband and wife, or for the civil partners, please remember that if a property they are owning jointly, the question says it is a jointly owned property, unless the percentage is mentioned, you will always assume that it is 50-50. And for percentage to be mentioned, there has to be joint declaration given to HMRC. Okay, now I take up almost one of the more, the last two topics which are remaining here, but this topic is very frequently tested in exam. So this is known as High Income Child Benefit Charge, CBC. Not the CBC that we do, it's a CBC Child Benefit Charge. Now comes the question, then what is a child benefit? First, then only we'll understand charge. So what happens in UK, and this is all there in the notes, so don't worry, you don't have to write down. What happens in UK? The UK government generally gives, to the mother typically, otherwise it can be given to the father, but any one of the parent. Typically it is the mother because she's the one who's taking care of the children. If father is taking care of the children, then this will be given to the father. So child benefit is basically an amount given by UK government to the one of the parent for raising the children, because the raising of children is very expensive. So for their monthly maintenance, their education, their upbringing, their other expenses, to meet out these other expenses, UK government give this kind of, you can say, an amount which is transferred to the bank accounts of one of the parent, and that is calculated on the number of children, and accordingly it is given. Generally it is only given for minor children, not for major children. Okay, typically I think up to 16 years of age only, the claim can be made, but there are some rules and regulations that is to be followed, but that is not there in the syllabus. Okay, so what we need to know is what is a child benefit. So child benefit is the benefit which is offered by UK government typically to the mother or any one of the parent, as the case may be, who's taking care of children. Now, when let's say mother is received the child benefit, so the HMRC says, okay, fine, that's not a problem if you receive child benefit, but now we need to look at your income. So what we need to look at is ANI. Remember the ANI that we did for PA, same ANI. So here says, please look at your adjusted net income. The one who's receiving the benefit, please see your adjusted net income. If your adjusted net income is lying between 60,000 to 80,000, then again you will have to bear a child benefit charge. That means on the benefit that you're receiving from the government, you have to return back a certain portion as a child benefit charge. So remember, like marriage allowance was a tax reducer of 252, it is a tax enhancer. So whatever amount comes in at the rate 20%, we will pay back to HMRC. Okay, we will pay back to HMRC. So Krunal, I hope you are able to follow, even though you're in 11th standard. Okay, no worries. So now this will be paid back to HMRC. Okay. Now, what amount will be paid? So step 1, we will calculate ANI. Step 2, we will see whether the ANI is between 60 to 80,000 or not. But why 60 to 80 only? Because child benefit charge applies when ANI exceeds 60,000. But once it exceeds 80,000, then entire amount that you receive from HMR, from the UK government as a child benefit will be a child benefit charge. 100% will be a charge beyond 80,000. Okay, 60 to 80,000 there will be some reduction, but beyond 80,000 it will be completely child benefit charge. So entire amount has to be returned back to HMRC. Okay, now look here. How do we calculate a child benefit charge? Again, I think I need to tell you the steps. So let's look at the steps. Step 1. Child benefit charge. Okay. Step 1. Calculate ANI. Here also you will calculate ANI. Number 2. Get excess over 60,000. So instead of 1 lakh, get excess over 60,000. Number 3. Multiply excess, not multiply actually, divide. So instead of taking 50%, we will take, calculate excess divided by 200. That means for every 200 pound, we will have 1% as the child benefit charge. For every 200 pound that we incur, okay, for every 200 pound of the excess, there will be 1% child benefit charge. So let's say the excess is 10,000. So then it will be 10,000 divided by 200 multiplied by 1%, which is 50%. So 50% of the child benefit that you receive will be a child benefit charge. Simply it means. Okay. So calculate ANI, get excess over 60,000, calculate excess multiplied by 1%, and fourth, that will be child benefit charge. Okay, child benefit charge. Okay, I'll just show you how do we calculate the child benefit charge. So let me take an example to make you understand this. These are all the examples that you would be doing. Some we will be doing in the class, some we have already done yesterday. Yeah, let's look at this. Ralph has a salary of 68,000. Okay. Now he received a child benefit of 2,500. Calculate the child benefit charge. Step 1, ANI. Now you can see your ANI is 68,000 only because there is no other gross gifted donation, gross personal pension contribution, nothing like this. Number 2, what is excess over 60,000? Excess is 8,000, right? Number 3, calculate 8,000 by 200 multiplied by 1%. That will be 8,000 divided by 200 multiplied by 1% is 40%. So your child benefit charge is 40%. Step 4, what is your child benefit charge? 40% of child benefit received. Child benefit received is 2,500. So 40% of 2,500, which is 1,000. So my answer here is 1,000. Clear? Based on this, you will try this question also in homework. Okay, but just one pointer I have to explain you. Now there is just one condition that says if both the parents have income going beyond 60,000, mother and father both have ANI in excess of 60,000, then the parent that has most ANI, highest of the two, will be subject to child benefit charge. I'll take the example again. Let's say the mother has received child benefit, but mother and father both have the ANI beyond 60,000, then the one who has got the highest income will be taking the child benefit charge irrespective of the fact who received it. Okay, let's take the example here. One more example I'm taking you. Samantha is divorced and has two children aged 10 and 6. She has a net income of 67,500 in 24-25. Samantha made personal pension contribution of 4,500 gross. It is given to you. For ANI, I need it. She received child benefit of 1,828. What is a child benefit chart? Again, let's do steps. So here, I'll do it here. First, ANI. What is the ANI here? ANI will be net income less gross gifted donation and less gross personal pension contribution. We just have gross personal pension contribution, so that will be 67,500 less 4,500 because gross is already given to you. So ANI will be 67 minus 4,500, which is 67,500 less 4,500, and which is 63,000. Got it? Second step is get excess over 60,000. Excess over 60,000 is 3,000, right? Then third, take 3,000 divided by 200 and multiplied by 1%. That will be 3,000 divided by 200 multiplied by 1%, and that becomes 15%. Clear? So that means your child benefit charge will be 15% of the child benefit received. So fourth, what is the child benefit charge? That will be 15% of 1,828 because that is a child benefit received here. That will be 1,828 multiplied by 15%, 274, rounding off. So here I will write my answer as 274. Clear? Now I hope absolutely your child benefit charge is clear. Okay, let's take it further. Again, these limits of 60,000, 80,000, it will be given to you in the exam. That is, the excess over 200. For every 200, you will have 1% child benefit charge. That will be given to you in the exam. So even if you forget, don't worry. Your examiner will give you this data. Okay, let's look further and the last topic of this chapter. The last topic of this chapter is accrued income scheme, and post which I'll discuss for the ATX students the pro forma changes, because most of the things will remain same as the basics in taxes, just that there will be pro forma changes and some other changes applicable. Okay, so let's look here. Okay, accrued income scheme I'm going to discuss about. Now first let me give you a background. So what happens here? There is Mr. A. Okay, he got a bond, which is, I can say, or a gilt. The term that you will find in the exam will be a gilt. Gilt means what? The government securities are also called as gilt. Okay, government securities. Now, the good part for gilt is when you sell these government securities, you don't pay any tax on it. But when you earn income from these government securities, then you pay tax as the interest income. Okay, I repeat again. When we sell off these gilts, then we don't pay any taxes. But when we have when we earn interest from them, then that is going to be taxed as the interest income, right? That is going to be taxed for sure. So these are the bonds or the gilts, that is the government securities. Okay. Now Mr. A has subscribed to this bond. And the good part of this bond is that this bond pays interest. Okay, boss, when is this bond paying interest? This bond is paying interest on 2 days in the year. You know, like when you apply for FD, your FD also pays you like quarterly interest or a half yearly interest or a yearly interest. Typically, these bonds will pay you half yearly interest. Okay, so what is the half yearly interest that they are paying? They are paying interest half yearly. Okay, let's say they pay interest on 30th June 2024 and the next interest that they are paying is 31st December 2024. In your exam also typically you will find this. So the bond interest will not be taxed as per the tax year basis. That means you will not calculate months from April. Okay, you can see that it is half year. So the period is starting from January. For bond, then you will take the date as from the January to June. Why? Because interest is accruing on June and December, which is in your tax year. So you just have to see the interest accrue date is in the tax year or not. If it is in the tax year, then you will accrue it as per the number of months from the last date to the next date. The last interest date is 31st December. So the next date will start from January only. Clear? So you will take from January to June. Don't, okay? So please be very clear about it. Now let's say it is paying interest annually, half yearly. Now Mr. A is very clever. What he does is he sells bond to Mr. B on 31st May 2024. Okay. Now when he's selling the bond on 31st May 24, you know this is a gilt. So gilt is exempt from tax. That means there will be no CGT. So what Mr. A did, he saved his taxes, no? Because on selling, he will not have any CGT. Plus, he sold this on 31st May 24, just before the interest date of 30th June. So he is not liable to have any interest income also. Correct. So he was winning from both the sides. Now he sold the bond to Mr. B at a very good price because of course he will say, boss, I'm giving you the interest income also. So you please take it at a very good price. So he has given the bond to at a good price. Now Mr. B will receive all the income on 30th June and so he will be paying the taxes on this entire interest income on 30th June. Right? Now let's say on 31st July, again Mr. A buys this bond. So now again Mr. A has got a bond. Maybe he wants to keep it as a security and all. So he can still use it for 3-4 months and then he will sell it again before the interest date. So you can see that this was a continuous approach that Mr. A was adopting in order to, ensure that he's not having any income taxable in his hands. But is this the correct approach? You will say no, because Mr. A, like in this case, was holding the bond for good 5 months. So Mr. B will question HMRC and say that, boss, why am I subject to tax when Mr. A is holding the bond for 5 months? So ideally, I should not be penalized for the same, right? So please don't tax me. And that is why the concept of accrued income has come into place. That simply says, very simply, that look, Mr. A, for how many months you held the bond? You held the bond here for 5 months. So for 5 months, you will pay interest. And for 1 month only, interest will be borne by Mr. B. Correct? Because he is holding the bond only for 1 month. And Mr. A is holding the bond for 5 months. So therefore, he would pay interest for 5 months and Mr. B will only pay interest for 1 month. Absolutely clear on it? Absolutely clear. Now, when Mr. A buys the bond again, then again you will see the same period, and accordingly we will tax this period in the tax year. Clear? From 1st January to December. Because you will only tax it as per the accrual dates. Whether this accrual date is falling in the tax year or not, accordingly we will tax it. Clear? Let's take an example to be absolutely crystal clear about it. Yeah. Okay, let's take this example number 17. There are two examples on this. So the next one, I'll do both the examples in the class so that we are absolutely and thoroughly clear about it. Okay, let's take the next one that says the oven owned 10,000. That is the nominal value. Always remember we calculate interest on the nominal value only, which is the face value. 5% UK government loan stock. UK government loan stock is nothing but your gilts, government securities. Interest was payable on 30th June and 31st December each year. Owen sold the loan stock to Yovan on 30th November. Stop. So for how many months he held the bond? He held the bond till 30th November. That means he held the bond for 11 months. Owen. Right? And only 1 month it was owned by Yovan. Clear? At the sale proceeds of 11,208, it is not needed. You will only calculate interest always on the nominal value. Okay, it included accrued interest of 208. Don't look at this. You will calculate the interest for the full year. Now, what is the taxable amount for Owen? For Owen, it will be 11 by 12, 5% on 10,000. This is for Owen. And for Yovan will be 1 by 12 multiplied by 5% multiplied by 10,000. Clear? So the amount will be 11 by 12 multiplied by 5%. No, 10,000 multiplied by 5% multiplied by 11 by 12, which is 458. And for Yovan it will be, and you can always cross check also. Okay, you can always cross check because 10,000 into 5% is 500. So the total should be 500 only. Okay. Now 500 divided by 12 and I get here 42. When I add 42 and 458, I get 500. So my answer is correct and I've taken it for the correct months. Clear? Let's take the next one also. On 1st May 2024, Caroline bought some 4% gilts from Jamie. They have a nominal value of 50,000 and it was bought on 1st May. So you don't have to take it from 1st January. The date is very important. The buying date is 1st May and pays interest on 31st March and 30th September each year. She paid 52,000 including interest on 1st May. Doesn't matter. Nominal value is 50,000. That is important. Sold them for 54,500. Again, it is not important because on sale, whatever gain you earn is not subject to tax. CGT. And here we are just taking care of interest income. So I don't need the value at which it is sold. And it is sold on 31st December 24 to Tyrone. So Caroline held it for which period? Please mention it. From 1st May 24 to 31st December 24. Is this falling in the tax year 24-25? Yes. So we will put it to tax. How many months? May, June, July, August, September, October, November, December. May, June, July, August, September, October, November, December. 7 months. No, 8 months. 8 months are going to be here, right? So we will take 8 months. So my answer would be 8 months multiplied by 4% is the interest rate and the nominal value is 50,000. So I will get here 50,000 multiplied by 4% multiplied by 8 by 12. And I get here 1,333. So this is my answer for the interest that will be accessible in the hands of candidate. Right? I hope I'm very, very clear on it. Now, guys, let's do some questions that, I will cover today for the portions that we covered. Although we have already covered questions on child benefit, I'll take qualifying interest relief question also. Let me just have a look. Till yesterday, um, we had covered certain questions. I know you can do all this. There is absolutely no challenge. And take up a question on qualifying interest relief. So I'll take question number 23. Rest all you can do, right? So I'll take question number 23, the last question for today. Now let's look at this question and we will understand the qualifying interest relief from this. Alice is a self-employed person and she had the following income for the tax year 24-25. Tax adjusted trading profits are 54,500 and bank interest is 1,000. During the tax year 24-25, Alice paid 2,000 of the interest on a loan. So 2,000 is the interest amount on a loan taken out in 2016 to finance her contribution to the capital of the firm in which she is a partner. So this is a loan taken to invest into the partnership. It is a qualifying purpose. So this interest will be a qualifying interest relief. How would be the tax liability? Let's do it here. So we have two heads, NSI and SI. First is the trading profits and the other is the bank interest. Trading profits will come here 54,500. Bank interest will come here 1,000. Okay. Now I will take the totals and that will be my total income. So total income will be 54,500 and here the total income will be 1,000. Now you know there is a qualifying interest relief here. So guys, we will reduce the qualifying interest relief. All of you be with me. Okay, let's reduce the qualifying interest relief. So I will reduce qualifying interest relief and it is going to be 2,000. Okay, is my qualifying interest relief. And you know that like PA, like all the other adjustments, we do first against NSI. So here also first I will reduce against NSI. Since it is getting fully reduced against NSI, there is nothing to be used against savings income. So I will reduce it and then I will get my net income. Net income will be 52,500 and 1,000. Now, is this exceeding 1 lakh? No. When you add it, you get total as 53,500. It is not exceeding 1 lakh. Since it is not exceeding 1 lakh, then there is no need to taper it. Right? Taper PA, nothing. You will get full PA. So I will reduce PA 12,570 and I will get my taxable income. So taxable income will be 52,500 less 12,570 and I get here 39930. And here I will get savings income same as 1,000. Now let's calculate tax. So when I calculate tax here, okay, when I calculate tax, let me calculate tax here. Okay, so tax will be simple. For NSI, you will calculate 37,700 at the rate 20% and with this you will add the remaining, which is 39,300 less 37,700, which is 1,600. 1,600 then will be taxed at 40%. Right? So this will be 37,700 multiplied by 20% is 7,540, and 1,600 multiplied by 40% is 640. So total I get 8,180. Okay. Now this is the total for non-savings income. Now let's get the total for savings income also. Now what category is the taxpayer? It is, since it is exceeding the basic rate band, but it is not exceeding the higher rate band, so it's a higher rate taxpayer. Now, when you know he is a higher rate taxpayer, then what is the savings nil rate band applicable? Because 5,000 starting nil rate band is not applicable. Why? As NSI is beyond 5,000, so that is not applicable. Now, the savings starting nil rate band will be applicable based on the category of the taxpayer. So, since the category of the taxpayer is higher rate, so therefore the tax that rate that will the nil rate band that will be applicable will be 500. So that means for this 500 will be taxed at 0%, and the remaining 500 will be taxed at 40%. That will be 200. Okay, now you add it. So total I get 200. Now add the two and I get here 8180 plus 200. So I get here 8320. No, 8380. Got it? So this is my final answer. I hope I'm very clear, and all the tax students, I hope I was able to justify and clear to you the all the tax calculations, tax liability. Plus we also understood the income tax systems, the different definitions, the tax evasion, avoidance, all these concepts. Now to know more and more detail about these UK taxes, I urge all of you to please like, subscribe my channel. Go to my telegram channel as well, where I'll share where this file has been shared, so you can do more questions from there as well as subscribe my Insta page for more updates. And yes, of course, all the updates are there in the YouTube channel. Go through the orientation session for the tax batch for March 2026, and I hope to see you in the class soon, so that we crack and we excel in the exams together. Now all ATX students, hold there. Please don't leave. Just some more time with you. So let me share with you the format of the income, because rest all portions that we have done in basics will remain same. But for you, for ATX, what is the format that you will have? See, basic format is not changed. There's some additional points that will be there. So from the next session onwards, then we will be taking care of these additional points also, chapter by chapter wise. Like for example, see here, trading income, I've given the chapter numbers against them, so that's very easy for you to correlate. Okay, employment income is same like income tax. Okay, but here you have additional income, which is overseas income. So that is only a testing area for ATX students, where we take into account the foreign income also. Okay, then pension income is just like tax syllabus, and it is same like UK tax. It is same. Trust income is again a new area for ATX. Okay, UK property income is same. So this is a new area and this is a new area. Savings income is same. Interest received is same. Okay, that thing is same. Dividend. Now here we will segregate between dividend from UK companies and dividend from others, although it is same. It is going to be taxed in the same way. Okay, this is also same, this is also same, and this is also same. For loss there are changes, but then I will take those changes when we discuss loss chapter somewhat. Okay, now when we come to the tax enhancers, that is when you will have an increased tax. This will be studied for both tax and ATX students. Annual allowance charge on excess pension contributions. So this will be studied for both of the tax students, tax and ATX. Okay. Now for ATX students, this is a new point. When we do investments in the EIS, SCIS and VCT schemes. So that I will be taking in the upcoming classes. Okay, rest all will remain same, and then just one new concept for ATX, that is a double taxation relief. When a taxpayer pays taxes both in the foreign country and is required to be paying taxes as per the UK government rules as well, then what are the differences that is there in DTR, double taxation relief? So that is also new area for ATX students. Again, that we will be covering in the class. Okay, one more difference area for ATX. So now you have seen, right, when we discussed taxes, there also I told you one point that typically for tax students, the allocation of PA is that you will take it first against NSI, make it zero, only then you will use it against SI and DI in the same sequence, right? But ATX students, I want your attention here, because when we allocate PA, the law does not say that you have to allocate it in a sequence. For tax purposes, since we have to cover basics so that we have ease of calculations, ACCA has recommended that approach. But typically the law or HMRC says that you should apply PA in the most beneficial way, not in this sequence of NSI and SI and DI. Okay, so for ATX students, we will be following in this way only. Sometimes, see, if we think that our savings income is more or less covered by the NSI, more or less covered by the nil rate bands, then instead of using it against the savings income, I may just skip and use the P against dividend income instead of even using it against NSI. Okay, so sometimes it is necessary to offset the personal allowance in a different order, sometimes to preserve the savings nil rate band or the starting nil rate band. Let's have an example to understand this better. Okay, so I've taken this example for all of you. So let's quickly look at this example just to understand the most beneficial way to use P. And it's only relevant for ATX students. Adrian has falling income for the tax year, employment income, savings income and dividend income. If the PA is used against NSI first and then SI and then DI. If I use it in the same sequence, that first I use it against NSI, make it 0, then SI and then DI. Though we don't have any PA for DI, the total tax liability comes out to be 831. Now please see the beneficial approach, you will find the difference. However, if we use the P in the most beneficial manner, that means we first use it against NSI and then DI. Why? Why? Because in this question, after we adjust the PA here, the savings income was 2930. That was fully covered in the starting nil rate band, right? Because PA was 0. The taxable income of NSI was 0. Now let's see the situation here. If I adjust against NSI, now look here. My NSI is 0. That means savings income will get starting nil rate band of full 5,000. And just see the category of the taxpayer. Since the category of the taxpayer is within the basic rate band, the taxpayer will also get 1,000. So 5,000 the taxpayer will get savings, 5,000 nil rate band, starting nil rate band, and 1,000 he will get as savings nil rate band based on the category of the taxpayer, which is basic rate category. Clear? So total we get here 6,000 as the benefit. What is the savings income? 6,000. So instead of using the PA against savings income, as it is fully covered by the nil rate bands, okay, I can only cover it. I will leave it for savings income and I will apply it to dividend income. So what is the benefit? My full nil rate band is there, so my savings income is zero. PA, since I fully adjusted here NSI, my NSI is also zero. On dividend income, I'll get 500 nil rate band plus I've adjusted this PA. So I am on 6930 only. We will pay tax at 8.75% and on 6430 only because 500 is the NRB, right, for dividend. So we are getting a tax of 562. In the first case, when I was using it in the sequence, I was getting a tax of 831. So this is what ATX students have to keep in mind, that when you're allocating PA, don't use it in the same sequence. Please use it in the most beneficial way so that overall tax liability gets reduced. Keep in mind the nil rate bands of savings and dividend. Right? I hope I made myself clear. Uh, Rest all is same. Just few detailed pointers I will add to qualifying interest, because for ATX now we need to know the time period also. That's all. So just two more portions left. One is income of minor child. Again, this is an additional topic in ATX that says that if a child is under the age of 18 years and though he is a minor child, but if he is earning his own income, then he will be entitled to PA as well as the income will be put to tax. Look here, if the income that a child receive is even from, if the income is the child is earning income, let's say the parents have opened a trust and from that trust he is receiving income, or the parents have deposited the money for the child in FD and from FD he is receiving interest. So he is receiving income from the fund, right? Even he is not earning on his own, but he is still receiving income from a fund. So this concept says if the child is receiving income from a fund, which is, even though it is provided by the parent, first condition is earning income. Number two, it is exceeding 100 pounds in a tax year. Okay, then it is not his income, right? I repeat again. Let's say I have my children and I have opened an FD account for them, and instead of putting interest in my name, because then it will be added to my income and I'll have to pay taxes on it. So what I do, I transfer it in the name of my minor child. Now then in that case the child will be earning the income and ideally he should be putting to tax. But then HMRC says no, it's wrong, because child is not capable of earning that income. He is not doing any job. If he is if he is earning income based on his capabilities, then would be paying taxes on it. But now here comes the clubbing provision. Okay, here comes the clubbing provision that says if there is a fund set up by parent and on that fund interest is earned, so that interest will not be taxed in the hands of the child, it will be taxed in the hands of the parent who's transferred it. Okay, so this is simply the provision of clubbing here. So it will be deemed to be the parent's income and will be taxed in the hands of the parent only if this amount exceeds 100. If the income is only up to 100 pounds, then it is not exempt. Don't be happy, it is not exempt. It will be taxed in the hands of the child. But of course, it will be covered by PA. So it will be taxed in the hands of the child, it will be covered by PA. Right? Clear? Right? It will be taxed in the hands of child and covered by PA. Let's look at a quick question. Which of the following statements are true? A child does not receive their own PA until they are 18 years old. So I have already explained you this point. The child will be entitled to PA from the year of their birth. It doesn't matter whether they have reached 18 years or not. So this statement is wrong. That says that child will not receive their own PA until the 18 years old. So one is wrong straight away. Now, where income that a minor child receives is under 100 in the tax year, then it is deemed to be the parent's income. No, if it is under 100, then it is deemed to be the child's income. If it is over 100, then it is deemed to be parent's income. So this is also wrong. So the answer is D, neither 1 or 2. Okay, I hope it brought clarity. Now, we discussed about the qualifying interest relief, all of you. Just few pointers I want to add on. There was a clause that we discussed that the purchase of shares, the qualifying interest relief that we have discussed for tax syllabus was when the qualifying loan is a loan taken to invest into partnership or to invest into cooperative society or to invest into employer controlled company. Then we also discussed that loan is taken by a partner to purchase plant and machinery in the business or by an employee to be used in the performance of duties. Okay, just remember one thing, interest relief is only available for 3 years from the end of the tax year in which the loan was obtained. Loan was obtained in the tax year 24-25, so it will be available for 25-26 tax year, 26-27 tax year and 27-28 tax year from the end of that tax year, not in that current tax year. Okay, and if the asset is used partly for business purpose and partly for private purpose, then of course you will get relief only for the business portion. This is clear. Now apart from this, there is one more point in ATX. ATX says qualifying interest relief is also given on the loan taken for purchasing the ordinary shares. Ordinary means equity shares in either you're purchasing the equity shares in that company or you're giving a loan to a closed trading company. Okay, to a closed trading company. Now what is a closed trading company? Then I need to explain you later in the syllabus, because closed trading company requires me to make you understand more concepts. So just keep this definition on hold. When we study more chapters, that time I'll explain you with an example in terms of the closed relatives and the other definitions what is a closed trading company. So this I will be putting on hold and I will tell you later when we do that topic. But for the time being, just understand that for ATX purpose, there is one more qualifying purpose when a loan is taken to either invest in the ordinary shares or to give loan to a closed trading company. One more point, this also applies to the companies which are in EEA, European Economic Area, and that would be classified as closed companies if they were UK resident. So just understand, a closed company is a company which is a UK resident, and even if it is in EEA, it will be allowed. A lot of places you will find in ATX, EEA, although a lot of portions EEA has been removed as well, because UK is a part of European Economic Area. Okay, only this much you need to know. And one question more, I'll give you a homework, which is a part of this chapter, which is typically for a 5 marker, how would you calculate the income tax payable here? So we have done all the portions. Now it's like a comprehensive question that you will try. Okay, so that's all for the demo sessions, the 3 demos that I've conducted for the tax and ATX students, and I'll continue to do more and more updates as till your exams, and always also on a regular basis. So follow the channel for more updates. But yes guys, for clearing the exam, for passing it with great marks, because typically we have had great results in the past where we have had global ranks, 100% pass percentage also. So to carry on with the same, I hope that I see you in the class. So do the enrollments quickly and either connect with me in the comment section or on my Insta page, on my LinkedIn profile, or you can even connect with me on the Telegram channel. Join that if you haven't joined so far, and or even you can visit our website www.bbvirtuals.com, and see you in the class. So do your enrollments quickly, don't delay. See you in the class. Bye bye. Take care.